Welcome back to Etienne's Place. Happy to see you once again. Now, in our last video, we looked at business life cycle and we went through the various steps and stages in the typical life cycle of a business. Today, I want to look at the situation where you have decided that you want to get into business. However, instead of starting from, as we say, start from scratch, you may be contemplating the purchase of a business. So you don't want to have to go up through the, sweat and tears of establishing, getting things together. You want to go in and purchase an existing business already in operation. Now, let me hasten to say that whereas in the past I've always been warning, advising that what we present here at Etienne's Place is really a simplified version of the topic, whatever it is. And that, whether if you really want to get into the subject matter or if you want to go ahead and get yourself involved in whatever we discuss, then it's best that you seek additional advice, because this is really just for general top level explanation and understanding. Now, that admonition is super important when it comes to a topic as this purchase of a business. You do not want to embark on purchasing a business without proper advice, proper guidance, whether it be on the legal side, on the financial side. So it goes without saying. What we're about to discuss today is just top level, simplified, just for information. If you're really contemplating the purchase of a business, then yes, do not go it alone. Now, so you have decided that you're going to get into business, but instead of starting, you're going to go out and buy a business. Right off the bat, the issue of business valuation comes about. On the one hand, of course, the buyer would like to get the best for the least, and the seller is hoping to receive the most in terms of funds for his or her business. So the whole issue of business valuation comes in, and therefore the steps we take to value a business is very important, very critical. It can be a very complex process. We will not get into that. However, a couple of things I need to bring to your attention. And for purpose of illustration, I will use a simple business like a lawn care service. Let us say it's a lawn care service. I will use that to illustrate, from time to time, or to bring out my points. So you decide that you're going into business and you're going to purchase this business. Now, whatever is the agreed figure, whatever is the agreed sum that you're going to pay for this business, bear in mind, there are two distinct components to that figure. Generally speaking, on the one hand, you're buying what we call the assets of the business. And so, using a lawn care, if John has a lawn care service, John would have already had several lawn mowers, tractors, edge trimmers, hand tools, you name it, whatever. Those are the assets of the business. They have value. And if John has a physical location, a physical office, and you're going to be taking on that building, then all of that is what we refer to your tangible assets, things that you're going to buy, outright buy. So when you give money, you see that you're getting this thing or these things. That's one component, the tangible assets. Of course, to the extent that John may have some debt, the business, John's business has some debts, then if the assets that you're getting is valued at 10,000, and the amount of debt, we call it liability, that John has on the business is 2,000, then you're really netting off at a 8,000 net asset. So you're buying the tangible physical assets and the real debt of the business. That's one component of that purchase price. The other component, which is what I refer to as a gray area, is that piece of the purchase price that is related to the business. Now, careful. The lawnmower, the edge cutter, the tools, all those things, that is not the business. Those are the assets that are used to execute, to carry out the business. That is not the business. Mark, you cannot run the business without those tools, but that's not the business. That's not the business. And just to point that out to you, sometimes you find that a person say, okay, let me step back. Since it is possible for you to buy a business that offers services and not necessarily offer products, it means therefore that your business, in the true sense, is a little more than just the physical things that make up the business, that facilitate the execution of the business. So back to what we're saying, when you decide on a price at which you're going to buy this business, you need to bear in mind. So if the person is saying, okay, I want $50,000 for this business, it would be relatively simple to come up with a true value or a market value or a resale value or a replacement value of the physical assets. And let us say that when you do that valuation, you come up to $35,000. But this guy wants $50,000. So you're asking, well, if when we do all our valuation of these physical, real, tangible things, we're coming up with 35,000. Why is it that you're charging me 15,000 more for a cost price of 50,000? And the guy's gonna say to you, yes, this is the value that he refers to as goodwill. Goodwill. What on earth is he talking about? He's saying to you, having owned this business for the past 10, 15 years, having grown the business to this point, having established relationships with clients, having taken the business past the turbulent years, having seen the ebb and flow of the business and know that the business is, say, at the mature state, can hold its own, John, the owner of the business, is saying to you, you will have to pay for that value. There's value to that, and so you'll have to pay for it. Because if you had started your business from day one, from when you just conceptualize and move forward, you'd have had to go through all those steps. I have done it for you. I've brought the business here, and so you need to pay a figure that covers the physical assets of the business. We also need to pay a premium, and that premium is really that additional value that is regularly referred to as goodwill, and that is where sometimes the whole valuation of that aspect of it gets a little gray. So bear in mind now. So you're getting two pieces of value that comes together to represent the cost price of the business that you're buying. Let us spend a little time looking at the physical assets, the lawnmower, the edger, the whatever. Now, because this business, let's see, has been in existence for the past 5-10 years, it has history. So the first thing you'd want to do is to say, at least, I need to see 3 years, at least 3 years of financial statements. Profit and loss accounts, balance sheet. I need to see at least 3 years financial statement. And it would also be wise for you to take a look at the bank statements. Okay? Not just relying on the profit and loss statement and the balance sheet, but also looking at the physical bank statements, because you want to ensure that the picture painted by the financial report is supported by what actually happened as reflected in the bank account. So it's the financial statements consisting of profit and loss account, balance sheets, also the bank statement for at least 3 years. You also want to look at the tax returns. Tax returns, and depending on the type of business, hopefully John would have been preparing a separate business tax returns. So tax returns for himself as an individual, but a separate tax returns for the business. You want to also look at the business tax returns. Again, careful, it happens. You have you have the situation where two sets of financial statements are prepared at times. Not acceptable, not allowed, not legal, but it is done. Where once the financial statement is prepared to show a bright, rosy picture, but a bright, rosy picture means a profitable picture. A profitable picture means tax bill. So a person may prepare that for the purpose of showing a very thriving and successful business, but then may have a revised or a different version that they use to prepare tax returns so that they will minimize the tax liability. As I said, not acceptable, illegal, but it is done. So you'd want to look at the financial statements, P&L, balance sheet, the bank statements, but you also want to look at the tax returns that were filed. Go a little further. Yes, you will accept a copy of the tax returns from John, but go a little further. Apply to the IRS for tax transcripts, or have John get tax transcripts from the IRS, because once again, John may have a set of tax returns, paper return that he hands you and say, these are what I filed. But then you have no way of knowing that, yes, these are the versions that went into the IRS, unless you get a transcript, a tax transcript, to verify that what John showed as his business tax returns is actually what was filed with the IRS, and that those documents reflect what is shown on the financial statement. Good. So those documents together will give you a good picture of the history, financial history of the business. So you'll be able to ascertain how well this business has done for at least the past 3 years. That is going to show you the value that was created, the value that exists today, the value that you're buying as far as historical value created by another that you're now taking, and so you're willing to pay a price for it. Good. The other aspect of it, which would be the goodwill. Now, by its very definition, goodwill is that thing that has put the business in such a position that its future earning potentials are enhanced. So, because John has built a large clientele base, because John has a very good relationship with his customers, he's known for his good work. So the name of the company is synonymous with good work, reliable work, honesty, integrity. Then going forward, you as a new owner of this business, you're going to benefit from this goodwill. But it's obvious that the value of this goodwill to you is found in its ability to generate for you future income. So follow me now. The financial reports show you the value that was created from way back up to this point that you're now buying. So you have to pay for the value that was created. The goodwill piece has value because the goodwill is representing that thing, and I keep calling it that thing, okay? That thing, meaning that good relationship, that integrity, that honesty that was built by John over the years, that people come to recognize, so that when they hear about John's Lawn Care, they say, oh yeah, without a question, go for it. Okay? Call him, he's a good man. That goodwill is what is going to enhance the ability for you to have future earnings. So you need to pay a price for this business that reflects value created before you came on the scene that you're now buying, and also the company's ability to generate future income. So those are the two pieces that make up the cost price of you buying this new business. Fine. What is history is history. So the financial report, the tax returns, the assets, etc. That's history. They are here. That we can look at. There's nothing to do about them. The future earnings potential, however, is where you have a little fickleness. Follow me carefully. Yes, John created a lot of great relationships, and so he has clients that he has been doing their loans for the past 5 years and business good. And let us say, for argument's sake, that when you buy this business and you pay for the goodwill, you pay for the good name of the business, and you also pay for the client base that John has. Cool. But you have no guarantee that these clients know that they know that John is no longer the owner, John is no longer the operator. There's no guarantee that they will remain with you. And invariably, once there's a change of ownership, you're going to have what we call attrition. There's definitely going to be some fallout. So new business owners who have acquired, they plan for that. In the earlier years, yes, some people are just going to go while you work to attract new clients. So whereas you pay a value for the perceived goodwill, there's no guarantee that you will reap the full benefit that this goodwill is supposed to bring you in the future. Right? And that is why the valuation of goodwill, as I mentioned in my previous video, tend to be inflated by John's mind, because he knows what he has done, he knows how hard he has worked, he knows the value of the relationships that he has built, and he's expecting you to pay for it because he's passing it on to you. But there's no guarantee that it will remain with you, because people will move. Existing contracts may not be renewed, etc., etc., etc. Okay, so that is it. So back again, I was saying, when you're buying this business, you have to be cognizant of those facts. You have to be cognizant of those facts and realize that there are those two components to the purchase price. The price that you pay to buy this business. Right now, when it comes to the valuation of business, meaning the valuation of those assets, etc., there are a lot of different methods used to do what we call asset valuation. Technical stuff, won't get into that. But I just want to reiterate what I said earlier on. If you're buying an existing business outright, there's usually an arrangement where you're taking the business as is, meaning if the business has 50,000 worth of assets, meaning equipment, supplies, etc., etc., and if the business also have loans, tax debts, etc., you have agreed to take on everything. So it is wise for you, by looking at those financial statements and tax returns, be able to ascertain what is referred to as your net assets, meaning, yes, I'm getting 50,000 worth of assets according to the record, but I'm also taking on $10,000 worth of debt and other liabilities. So I need to say, on one hand, I'm getting 50,000 benefit, but on the other hand, there's a 10,000, negative payout debt burden. So I need to offset it. So my true value that's coming into me, which we call our net asset, is really not the 50, but the 50 asset less the 10 debt liability. So I'm getting a net asset of 40. So right away, I know that whatever price I pay for this business, 40,000 of that represents a net asset, which is all of that value that was created in the past, brought to the present, that I'm now assuming I'm now becoming the owner of. And in addition to that, we're going to add now this piece, which we call the goodwill. And this piece had passed value to the previous owner, to John. But this piece have no past value to you. It is only going to be valuable to you to the extent that it continues to generate for you what goodwill does. New business, good relationships, booming sales, etc., etc. And so when you pay a price for the goodwill, yes, you pay for it, but you're really hoping that the full value that this goodwill is supposed to bring will definitely materialize in your case. All right. So that is it. And quite often people will go the route of business purchase as opposed to, starting something from, as you say, from scratch. The other thing I want to point out is that there's a significant difference in the approach when you're talking about a business that deals in tangible goods and services like a hardware store, a grocery store, supermarket, because the inventory, the things that are bought and sold are things that you can touch and feel. So when you go and say to John, I'm buying your business, yes, you're going to get equipment, you're going to get edger, tools, etc., all these things. So you can say, okay, this is what I pay my money for. And of course, so that we add the kind of intangible, we call it. You can't touch it, the intangible goodwill. On the other hand, when you're buying a business that offers services, for example, let us say I was selling my business. What I offer, I offer services, I offer knowledge, I offer information. Now, when I sell you this business, I'm not including myself in the business. I'm not including myself. So to the extent that the business thrive, to the extent that the business is known, maybe for the information, for the expertise, for the integrity, for the honesty, etc., okay, that I would bring to the business. When you buy this business and you go with it, David is not coming with you. And so how do you go there and say, okay, yes, this is a business that you have come to trust. This is a business that has done so well. This is a business that has served you so over the years. Yes, it is. But at the heart of this was the service provider. But the service provider is not going along. So quite often when a person buy a business and it's a service business, they do a couple of things. One, they try to have the original owner stay around a bit and still be the face and sort of endorse the new owner, introduce them to, clientele, to your social circles, etc. Just to sort of hope that there will be some continuity in the relationships. Okay? That's one thing. Also, back to the point of valuation. Since the bulk, if not all of the business, when it's a service business, is really service that the individual brings. And if the individual is not going along with the business, then you're really saying that you're buying a value that you're hoping will continue to benefit you in the future. Mark you, if you bought an accounting firm, unexpectedly you're an accountant, you have the knowledge, you're going to get staff that have that sort of knowledge. And so, yes, it is expected that you will continue to offer financial accounting business services. But remember, your accounting, your financial, your business, whatever service you offer, yes, it is along the same line, the same industry, but they are not those offered by David. Maybe they are better. Maybe they're not maybe they're not as good. Maybe your services are better. But the better or worse of your services, at least in the initial phase, is in the mind and in the mind and in the eyes, so to speak, of the clients. If they had a lot of confidence in me and they came to trust me over the years and they're satisfied with my services, they're not going to automatically assume that because you bought my business, that they should just continue in utmost loyalty to you in the future. mark you over time when they interact and realize that, oh yes, you're keeping the flag flying high and you're maintaining the standard, then fine. But usually that's not a right off the bat occurrence. So when you buy a service business, then man, you really have to be very careful. And so that valuation needs to be done by a professional, a person who understands the industry, understands the business, etc., etc., etc. Okay, so that's what we will want to look at today. Um, yes, buying up and then to, and I won't go too deep in this. Remember, we spoke about business life cycle. We look at the various phases and stages. Now, you definitely want to know or to can reasonably estimate at what point in this business life cycle you're buying. And if you recall the various phases we looked at, and I'm not going to really go back in depth, but if we're at the phase where we're on the upward growth path, then it's a good buy. It's a good buy. The market is good, things are happening, things are booming, sales are increasing, and so you're coming at the time when you buy this business, hippie hooray. The chances of you succeeding, it is very high. If, however, you're buying this business because it is on the downturn, which quite often may be the reason why the original owner is selling. If you're buying the business when it's on the downturn, or even then, even more deceptive, if this business has crested, it has reached its upper limits, it has plateaued, maximum returns, maximum sales, maximum profit. Then once you have reached to that zenith, then the only place to go, I mean, you can stay there for a while, but it won't be indefinite. So the only place to go is down. So if you bought this business when it was doing that well, and say, man, I'm going to get into this business because that's the way to go, be careful. It may have outlived its 2-3 years of this riding the wave, and it is just now looking towards taking that downward turn. And so you thought you bought into this wonderful business, only to realize that in a year or so, things have changed, right? Not because you're doing anything wrong, not because the original owner blindsided you, but because you did not spend the time to ascertain at what point in the life cycle of the business you're coming in, that you're buying. So all of these are good. So right off the bat, given the various things that we have mentioned, the things that we need to take into consideration, you must agree with me that when it comes to purchasing a business, that is technical stuff. When it comes to purchasing a business, that is technical stuff. So I once again advise, warn. As simple as a business may be, and I'm using a lawn care because I'm saying, okay, it's not all that complex a business. You buy a couple of machines, etc. You do your thing. You know, I'm just saying it's not that complex. But as simple as a business may be, purchasing an existing business is not child's play. You need to do your due diligence, and the due diligence needs to look at the historical and the futuristic projections. The historical data, what has happened from then to now, and what you expect to happen from now going forward, and what your expectations will be based on all the things that we have looked at. All right, very, very, very important. So there you have it again. You decide you don't want to start a business from scratch, you just want to buy a business, go for it, but do your homework and engage a professional or professionals. And although we talk about the business side of it, I mean the financial side of it, of course, you know that there's a legal side to it that you can definitely, or you should definitely not overlook. All right. So there we go. Another episode trying to put us little businessmen in the path, in the mode to be successful, not to make blunders that will cripple us. We will not know everything, but at least the tidbits that we get here and there will put us on the right path. So once again, Thank you very much for joining me. I'm David. Etienne's place is my place, and I know that by now it has become your place. So keep visiting, keep dropping in. Remember to subscribe because I really want you to have this information. I really want you to have this information. If you notice, it's no cost, it's no obligation for you to come in and say, okay, David, I want to engage your services. Oh, yeah, I can give you some work, man. But anyhow, no cost, but very important. I need to empower your small business, businesses and get you on the right path. So remember to subscribe, keep informed, keep giving me feedback. As a matter of fact, I'll tell you, after I did my last video, a client called me with this very issue about, contemplating buying a business. And right away, that put in my mind, oh, that is something that a number of small businesses or individuals who are contemplating going to business may want to think, hey, let me go and purchase a business. So that's what I'm talking about. Your feedback gives me the content, the subject matter that I would want to explore. Very simple, but very useful. All right, so have a good day, have a good week. Keep on working hard. I always have to tell you because I know the value of hard work, consistency, bulldog mentality. But the heart of it all, keep God at the forefront of all that you do. Keep Christ at the center of all your plans, and success will be yours. God bless. We'll talk.